basically he is basically an economist and a corporate finance professional, has got over 25 years of experience in various sectors, including finance, banking, and credit, project management, HR, and legal. He is a doctorate in finance, and also a qualified company secretary, and has many post-graduation degrees also, with the different ranks in these universities. He is an overall he's also in a board and a committee member of various banks and financial institutions. He helps people to build policies, and also he's contributing to policy matters in various bodies. And he's a regular speaker at various forums, both inside India and outside India. And he has given a lot of sessions even to our BVA members. And also he comes on TV and media with various articles and his deliberations. Besides being humble, he is also an angel investor, and he is mentoring quite a few startups, MSMEs. With this, over to you, Dr. Kishore Nuthalapathi, sir.
Thank you, sir. Thank you for your generous introduction. Yes, sir. In fact, my background is full of BVA, IOV trophies. So, thank you for that, sir. With your permission, I'll take the presentation online so that it will be easy for me to talk. Yes. Hope the presentation is visible, sir.
Yes, sir.
Slide.
Yeah. You can make it presentation mode, sir.
Yes, sir. So now presentation mode, sir. Fine. Sir, in presentation mode, sir, please. Yeah, and moving, sir. 1 second. So slides moving, sir.
Yes, sir.
Please move.
Okay, thank you, sir. So, thanks to BBA for this privilege, and I could sense the quality of topics and the speakers BBA has been very selective about. Thanks to Chairman, Vice Chairman, Treasury Secretary, Vijay Ma'am, and all the leadership management committee. This is a sequential discussion. As I was asked to choose a topic of my interest, while we thought we'll discuss something on national accounting validation, nature validation, ESG validation, I chose this topic for one reason, which I'll speak a while later. Quick disclaimer, nothing much to read. It's a normal protocol sort of thing. Before we start our discussion, I request all the participants to take a quick self-check on the valuation aspect, which we generally do, so that we get into the topic and we understand deeper easily. Whenever you look at the valuation of any company, whenever you understand any company or you're looking at any number, be it in a publication about the yearly, quarterly, half-yearly numbers or the valuation or one of the valuation metrics, do you check if the financials are standalone or consolidated? Do you check the PE the moment you look at the price of any share, or when you're talking about the share price of any company, or do you ignore? Do you try to note the face value of the share which you are talking about? The price of a share which you are referring to has a face value, and would you look at the face value or not? Will you try to also understand, apart from the PE, the price of the share, the face value, do you also try to look at the book value of the share? Do you compare the share price with that of another, or do you compare the share price of the company with that of the same in the previous sessions? Do you compare the share price with the sector's leader or any other company? Here it is actually sector leader. Do you read accounting policies, auditors' observations, and clarifications in the director report, at least whenever you are making a valuation for a company or a share? And as a part of your understanding about the valuation, exercise of valuation, do you agree that adjustments, well in detail, and explanation of the adjustments forms part of the valuation? How many times you have done this exercise? How well have you done it also matters. Did you note that the corporate actions generally make some difference? And do you have a practice of understanding what are the actions that have happened in the recent past or are happening now? So whoever have got 10 can get your cup of coffee. Whoever did not get 10 can get a cup of coffee either. So we get to the context to understand the valuation of a company. Now, valuation multiple. What is valuation multiple? This is not known to other than financial professionals in its true spirit. Everyone speaks what is valuation, what valuation multiple, etc. A quick survey tells us that 90% of the financial professionals speak about valuation. Almost 90%, a shade lower than 90%, would have done a valuation exercise in detail, precisely, rule of thumb, back of the envelope, or orally at least once in a decade, and more than that as they put in more years of experience. Then what is it? What is that we understand and non-finance professionals do not understand about valuation multiple? While we understand it in true spirit, let us have a quick look at what it actually means in true spirit. It is simply a ratio that expresses the market value of an asset. Asset being company, asset being stock, asset being project, asset being country, or asset being a portfolio, relative to a key financial or operating metric. What is that metric we are referring to as a relative comparison is what we'll see as we come across the other instances. But in simple terms, it is a ratio expressing the market value of the asset in comparison with another metric. In addition to the explanation given by the CFI and other institutes, the statistics which you are stating as a metric should have logical relationship as a driver of the market value of the asset which you are valuing. Only then is a valuation valid, is a valuation metric useful. There are a lot of challenges with the multiples. No two companies are identical practically. Adjustments need adjustments, which we do rampantly. Changes in the business mix could not be factored easily. With many multiples, selection is a challenge. 30 years back, when we were first in the industry, one of our group companies started mutual fund company being supported by the banks. Then we were very easy to understand. We were given to understand mutual funds are alternative to stock markets. Today, if you see, there are so many mutual funds. Selecting a right mutual fund itself has become a challenge. Unlike stock market or mutual funds, which mutual fund hardly 4 5, okay, fine. And what is the market cap or AUM? Hardly 12,000, 14,000 crores. That was a scenario versus today 5 trillion AUM, 15 trillion AUM, and so many mutual funds where you can't so easily select which mutual fund. Same has been the case with multiples also, if not with that magnitude. Multiples are static. What is the last time you did something? I've been to so and so place recently. How recent is that? Is a question. It could be 1 year back, 1 month back, it could be a decade back either. So multiples are static, situations are dynamic. These two are not always in harmony unless you make the adjustment. We have got confusion on which multiple, and we have got confusion on which variable as well. Is it historical EBIT, current EBIT, or forward EBIT, or historical PE, current PE, forward PE? Which of these three should we select is also a confusion, because the context and the application will have to be in harmony, and not all will be familiar to apply a right variable for the context. Unique business, which has no comparison, which has high level of economic moats or business moats, has no comparison. Therefore, there may not be a suitable valuation metric or multiple to use. What you use is correct, what you use is also wrong, because there is no comparison. For such kind of companies, multiples may not serve complete purpose. And if numbers are negative, where the company is yet to make profit, yet to break even, yet to have even contribution profit, then you can't assign multiples easily, although there are few multiples which we'll see in due course. And we look at averages. Averages by drawing from range of multiples. That is even bigger goof unless we make proper adjustments. What are the limitations of the multiples? The stages, phases, and the managerial quality, management quality, and its growth prospects all cannot be so easily differentiated using a multiple. And multiples do not factor in the future cash flows. You are looking at the current, even if it is forward, it's only 1 year from now. So today, if you are valuing, you will value basis 26 number. That's the norm. You will bother least about 25, 24, how much ever you talk about historical earnings, current earnings, the valuation in majority of the cases, what is that majority? Could be 99.99 as well.
Mr.
Valuation,
Kishore.
yes, sir.
Mr. Kishore, good morning, Chandrasekhar here.
Sir, please.
Can I request? See, we are again starting with the multiple challenges. Can you just throw us a light on the what are the multiples we use? How do we calculate? Just can you throw some light on that?
Pardon, sir. Multiple. Kindly repeat the question, sir.
No, we started with the challenges in the multiple selection.
Correct,
Can you
sir.
throw the light on the what are the multiples at the standard? How do we calculate just on a broader basis? Is it EBITDA multiple, sales multiples, and what are other?
Yeah. Yes, sir. We have it in our coverage, sir. We are going in sequence. We have it.
Okay, sure. Okay, thank you.
Thank you, sir. Thank you, please. So multiples do not factor in the future cash flows. So when I say future cash flows, as all of you understand, it could be discounted cash flows, etc., where you have the flexibility of discounting the future 5 years, 8 years, ideally 8 years, and if there are contractual cash flows up to the contractual period or penultimate year, leaving some tail period. So that kind of future cash flows capturing is absent in the multiples. Multiples is with reductivism, which means it is oversimplified for my usage, for our usage, that the strength of actual valuation or the nitty-gritties of the valuation are knocked off, and we are talking only on the top line basis or the high line basis in a way. That kind of oversimplification is with the valuation multiples. And multiples distort the markets with incorrect benchmarks. So a person or a company in the sector will try to match its valuation, understand its valuation vis-a-vis the bellwether of the sector. Let's say an IT company with 2 persons and 2 lakh rupees revenue will speak about valuation, its valuation vis-a-vis that of TCS, Infosys, Wipro, etc., saying we're all in the same sector. That's the PE multiple which is applicable for me. I've already made 1,000 rupees profit and into so and so. This is my valuation. Good for nothing. But this is a distortion what these benchmarks sometimes cause. When markets are not normal, multiples are static, as we referred, and will not be applicable unless you give the proper adjustments with valid justification. And multiples look at the current, the past, and 1 year future at best in the forward case. Therefore, the capex requirement in the due course is rarely captured unless you give adjustment with a levelized multiple adjustment, factor adjustment, which we do even rarely, even we do rarely, because we go with the high line, top line numbers and limited forward looking insights. So the capex is one and forward looking insights is another, that is also absent. And it has got huge potential. Valuation multiples have huge potential. Otherwise, the world would not be speaking about valuation on multiples basis. But it has the need for manipulation. What is manipulation research? Manipulation research is making proper amendments to make the variable, to make the static levelized, to make the variable justified. So those manipulations are required. When there is a scope for manipulation, while it is stated as a need, the manipulator ought to be knowledgeable, failing which the valuation could go for a toss. Fine. If these are the limitations and challenges, so many in number and for discussion, what are the advantages in using the multiples? They set benchmarks, good or bad, they set benchmarks. And in most of the cases, it is these benchmarks which drive the valuation of other companies. Because the benchmark has to be comparable company, the non-business investments, useless investments, diversifying for whims and fancies, all will be under check because you will miss out being comparable with the company or the good company. Therefore, the valuation multiples bring in a bit of discipline in the businesses in avoiding non-trade investments. Trade investments, non-trade investments. We're talking about our AS language of what is trade investment is anything that related to your business, be it your project, be it your subsidiary into the project, or be it into any asset required for the business. All of them trade investments. When you say non-trade, just like that, investing in other instruments not related to your business, not required for your business. They could be profitable. They could be more profitable than your business, but they are not related to your business. Then it is non-trade investment. Multiples trigger efficiencies and avoid redundancies because you always check yourself, are we on this multiple or not? And if you're not on this multiple, you'll try to pull up your business to match the multiples. In the process, the redundancies will be avoided, inefficiencies in a way. Multiples help quick estimate and on a normative basis. So price of fuel XYZ, let's say $87 a barrel. This is normative. It is 70, then it is very competitive. It's very cheap. It is 102, it's quite dear. So these come because there is a normative number which is changing over a period of time, but stands valid for a given number of years, be it 4 years, 5 years. So in this cycle of 4 years, you always have a normative number. It helps you to make a quick estimate of the price or your view about the situation in the market. It's easy, simple, speed to value. It is adaptable to various sectors. Like you would say 2:1 current ratio is the best. A banker would say 1.33:1 is okay. Those are sector agnostic metrics, useful and used for all the sectors. Similarly, the price earnings multiple of the country of a project of an asset is useful for all the countries, regardless of the intermediate changes or the dynamics of the countries where we would be speaking about. For sector experts, this is handy instant, which means as an infrastructure sector expert, if I am saying 22 is my multiple, it is sacrosanct. I'm talking about a comparable company. I'm talking about an applicable, valid, justified multiple. and I'm talking about my company, and the valuation what I speak as the sector expert can have at best a small variation of 5 to 6%. I am near approximate, and in most of the cases, I could be accurate as well. This captures the mood of the market. As a multiple is static, but as you apply the multiple with situations emerging, it could be dynamic as well. And when it is dynamic, it captures the mood of the market and the market prices. It's relative, but not intrinsic, which means it is vis-a-vis a situation, another country, another company, another stock, but it is not the intrinsic valuation because you are making a comparison with another country, project, stock, etc. But it helps in initial screening, ranking of the projects, ranking of the companies, ranking of the stocks, and to start the subsequent process of detailed valuation. So what are we doing? Valuation. What did you do with the multiples? Valuation. What do you do next? Again, valuation. Which means you will value using a multiple, and this is a basis for you to do a detailed valuation. Because of the screen, I am not able to see my own titles. I am just guessing what this title is. Fine. So there are many multiples. Few of them are here. Entity multiples, enterprise value by sales, EV by EBITDA, EV by EBIT, EV by invested capital. In cases where you need a license and the license will be given only on a batch basis or once in a while as per the policy, there is no possibility for you to get into this business because you miss the bus, or you will have to wait until the next policy framework is out and you apply and get the license. Such instances will have valuation going on invested capital with license into the multiple, that is EV by invested capital. EV by contribution profit. Paytm is the best example for EV by CP. EV by free cash flow or the cash flow from operations. EV by gross market value or gross order value.
Sir, 1 minute. This contribution profit, you said Paytm. I did not understand. Can you please? Contribution profit.
Yes, ma'am. Contribution profit as a concept is not new, but thanks to our friend Vijay Shekhar Sharma, he popularized it. What did he do? He said, your S, sales, minus V, variable cost, is contribution. Contribution minus fixed cost is your profit. Now, my fixed cost could be absorbed over a very long period because most of my fixed cost is an intangible asset. So the fixed cost apportionment which you do can wait until you break even. If you have to, I'll take the example of a wayside cart selling 2-piece idli for 20 rupees. That is my standard example in all the cases. You are discussing about country, we are discussing about the United Nations parallel organization, or we are discussing about a small case. At all times, I take this simple example. How do you set your price of 1 plate 2-piece idli? Do you decide what is the costing and then you arrive at 31 rupees per plate, or do you derive the costing and say, okay, 12 rupees? No, you go by the market price. What's the market price? 20 rupees is the price which is set by the market for 1 plate 2-piece idli with chutney, with katari sambar, or the cup of sambar, etc. Whatever. You have not decided it. What did you do? You try to understand what volume should I be selling to have profit within this price of 20. So if I sell 250 idli a day, I'll be able to earn my required profit margin with this 20 rupees. If I want 15% return, not 12%, I should be able to sell at least 350 idli. So it is the volume what you're deciding and you're understanding, can you be in the business to make that kind of volume on your business or not? So what is that contribution profit? It is your sales minus variable cost. Then to make fixed cost less important, you will have to increase the volume. Because you have the scope to increase the volume and make this fixed cost very, very minimal on the overall price, contribution profit is important. For the companies which are yet to break even, is the concept of our good friend which has its own logic and is bought, adopted, rather accepted by the market. Then equity multiples. These are for the stock, for a given stock. Price earnings, price to book value, price to sales per share, price to cash flow per share, of course, price to operating cash flows, and dividend yield, DDM model, where you calculate on a reverse basis. Either you dot capital market line or you compute with a simple average, either way. Then capacity multiples. These are also rampantly seen in the industry. If I'm talking to a hotel company asking what's your valuation, he'll say, I'm 500 keys. He didn't speak. She didn't speak. What's the valuation? She said 500 keys. I don't need to listen to Pavitra Shankar again to understand what is the valuation, because she has already told me that it is 500 keys. So 500 keys, then my question could be 3-star, 5-star. If she says 3-star, oh, 500 keys into 4. So your 2000 crores, your enterprise value is 2000 crores. Yep, you're right. This is the valuation multiple that helps me understand the valuation of the company we spoke about. Same is the case with hospital, number of beds. Same is the case with benches, the school. If Nspira is having so much of volume, the underlying benches which it has occupied, which gives that kind of valuation for them, which has investors like the Morgan Stanley, the Goldman Sachs, and the likes, GIC of Singapore, etc., and the likes, is all on a highline basis with the number of benches occupied by 3 students a bench into number of benches. That's the valuation multiple on capacity. And meters in case of length of the pipeline, etc. Liters in case of milk capacity, etc. These capacity multiples are rampant for telecom towers, for steel manufacturing, for cement manufacturing. You would have heard many for cement manufacturing. Similarly, for textiles, spindles also is capacity. There are many capacity multiples. Few of them we know, few of them we may not be knowing also. There could be so many multiples. However, there are 4 broad categories of multiples. 1, book value multiple. I spoke about the license factor. I did not speak. It is about the real estate companies also. Book value multiple will be valid. Book value multiples will be valid for companies which have entry barriers, regulatory or contractual. And for example, you have to apply for a dealership of Kia vehicles. They may be having a policy of giving license or distribution once in 5 years. Until 5th year ending, you will not be able to apply because they will not accept any new distribution application. In between, if you want to get into the business, you will have to look at the value of existing business, who is willing to sell, assign the multiple, arrive at the value, negotiate, make adjustments, and then settle and acquire the business. So what do you look at? Book value multiple is what serves you the best in that case. Real estate, that's the example. And license, regulatory, contractual, as I said, same example. Revenue multiples are the equity multiples what we spoke. Earnings multiples are the revenue is the sales. Earnings are more like profits. The earnings multiple could be contribution profit as well. And capacity multiples what we saw. These are the broad 4 categories. Okay. So we look at each of the multiple quickly before we do the math of the multiple. We have sufficient time. We have done only half an hour. We're going fast, but it's fine. First, price earnings multiple. This is the most widely used multiple across the world for stocks, for companies, for projects, for asset classes, for portfolios, of course, and then asset classes, and for even countries. What does it measure? It measures the asset's current price, the company's current share price relative to its EPS. So the inverse of PE is the return of the company, which means 1 by PE is the return of the company theoretically, while there could be a difference in its actual return as you compute. In the long term, if you compute, the return of a company is 1 by price earnings multiple, or 1 by the return is the price earnings multiple of any company. High PE suggests stock is overvalued, which is the common notion all of us will have. However, it need not be always considered as overvaluation because of two reasons. Reason number one, the stock may be performing so well and would continue this well in the days to come as well. And therefore, you're okay to pay higher price per earnings because it pays you off, which means the PE being high need not be considered as a negative if the stock has further scope for higher growth. The second reason we discuss after this second point. And the low price earnings generally indicates overvaluation, as the high PE generally indicates overvaluation. However, the lower PE may also give you a hint, like the recent run of the IT stocks during the past 15 months, with small aberrations here and there. What you have seen is the profits are good, presently good, as good as they were, in fact, better than they were in the past. But the guideline of the companies, the guideline of the sectoral experts, and the guideline by the government supported institutions hinted that going forward, the IT sector may not command same level of profitability, while they may command profits in absolute terms. That guideline made the investors to look at or to drive the price earnings multiple applicable for the sector lower than it was earlier. Strictly speaking, historical, current, and forward, all three earnings are good. But it is the future guideline what made the analysts and the investors or the companies to look at decline in the future earnings, and therefore a lower price earnings multiple was adopted. And what's the other point I mentioned? While PE as a standalone multiple is very useful, indeed useful, we should always use the price earnings growth, PE by G, as a clubbed multiple along with PE to make any view on any company or stock if it is highly valued, lower valued. If price earnings growth is less than 1, yes, it is fairly valued and you can enter. If price earnings growth is more than 1, yes, it is overvalued and it's better you pair your positions in the stock. PE compares companies, sectors, countries, as I mentioned. And different industries will have different typical PE ranges. There is no one PE for all sectors, while country could have one PE which could be applied for all the sectors in the country. Still, some sectors could have higher PE, some sectors could have lower PE. Therefore, that universal application of country PE is incorrect if we are doing so. This we spoke trailing, current trailing forward, it's the same thing. Generally, current PE is of a bearish analyst or realistic analyst who says now is important for me, not the past, not the days to come. So the last March PE, what is available with audited number is what I depend upon, is a bearish or realistic analyst view. The trailing PE, I am fine, but let me look at the trend of the company. The trend of the company is not last March. The trend of the company is the December audited, unaudited provisional numbers and past 4 quarters. So past 4 quarters is not for calendar financial year. It is calendar December to December. So that is trailing PE, past 4 quarters. When you are in June, you may be looking at until June last year. You are in September, you are looking at September to September, 4 quarters. That's a trailing PE. That's of, current PE is of realistic, is bearish. Trailing PE is relatively of realistic and the justified analyst view. Forward PE is of bullish analyst view, taking the next 12 months what it could do as per the guideline, as per the company's market share, and as per the overall sectoral moment, how the IT sector is doing in this case. how the infrastructure is doing in this case. So how is the sector doing, and what could be the performance of this company having this kind of market share in this sector? That is forward PE. This is of bullish analyst tool. It's very apt for stable, profit earning, and matured companies. For a matured company, if there are 3-4 matured companies, let's say telecom companies, 3 number, 4 in number, you do not need to look at the DCF at all. You can simply use valuation multiple and could arrive at the valuation multiple, which could be broadly said. Same is the case with at least 70% of the hospitality units, if not the companies. So about 70 to 80% of the hotels will have the same multiple, which is applicable across, because they're in the similar business, similar metrics, similar profitability, similar volumes. It is the whole of the country what will drive the applicable variable statics or dynamics for all the companies in the sector. Now, price to book value. It measures the market price of a share relative to its book value. And is it applicable? Is it valid? Of course, yes. What's the book value? The intrinsic value of the company as per the balance sheet at the moment, or the same trailing current historical will apply in all cases. Only thing is, generally, the trailing and current are only applicable because other than for PE, for other multiples, forward is more of a projection than of an estimation. And PB, PBV or PB ratio is more relevant for asset heavy industries like banking, insurance, manufacturing, and real estate. So if you see the banking industry, 2 times the book value has been the standard multiple. Like 2:1 current ratio is a standard multiple or metric which we say for the past 100 years. For banking industry across the world, 2 times the book value per stock per company is the valuation of a banking company. That's the standard metric used. So you can imagine now how relevant the PB ratio is for a financial sector entity. And for manufacturing company and real estate also, PB ratio is very relevant, more so for a real estate. Another beautiful insight is price to book value is computed, can be computed also by multiplying price earnings with return on equity. So price to book value is not theoretical, it is as practical as any other accounting number is, because the price earnings multiplied by return on equity. What is return on equity? Net profit divided by the shareholders funds or net worth of the company. Net profit by shareholders funds gives you return on equity, multiplied with PE, the price earnings multiple, you get price to book value ratio or the multiple. Yeah, this is a repetition, it is suitable for these companies. And for what is it not relevant? It's not relevant for companies which are high growth oriented, which are tech oriented, which hardly have any book value, but have got huge IP driven market value, which cannot be captured in the books. And companies which have got huge human capital, the value of which, let's say something like consultancy, etc., which hardly has got some value in the balance sheet, but in realistic sense, it gets a lot of profits or revenues because of these assets. For those companies, it is not suitable. Then, people believe in turnover. As you meet your colleague CFOs in the market, before asking what is your salary, they'll ask you, what's the top line of your company? Okay. What's the top line of your group? If the first number isn't sounding good, there could be a follow-on question, what's the top line of your group? Or there could be one question, what's the top line? Sales, the revenue, the top line is very, very important for someone to command respect in the market, for a company to command valuation in the market. Revenue RODIA. RODIA is contest. RODIA means contest. So the contest is for revenue. Earned revenues you can book profits in due course. You will know how to make profits if you are good at making revenue. That's the philosophy of this metric. Price to sales, price to revenue, it compares the company's market value to its total revenue, as it is explanatory. But it does not consider profitability and cost efficiencies, because high sales may not mean high profits, may not mean profits only. The case of Policy Bazaar, case of Paytm, case of Tesla, for 30 years it has not made profits. For 30 years, Tesla had not made profits, kept receiving a lot of funding, kept posting a lot of capital gains for its investors, and finally it broke even thanks to the convoluted accounting methodologies. It broke slightly before it actually broke even, and it could sustain that long because of the revenue, the top line, and of course the research projections which they have been reporting. Cross-sector comparisons will be misleading because in a consultancy firm, sales of 10 crores is a big number. Sales of 100 crores is something which is mind-boggling. In a manufacturing company, 2,000 crores is a very big number. In infrastructure sector, 3,000 crores is very normal number. Unless you say 5,000, 10,000 crores, etc., you are not respectable in the industry. So sectoral comparisons aren't possible with simple price to sales per share multiple. Also, some companies could have the efficiency of having higher level of sales, lower profits, lower level of sales, higher profitability. Those differentiations aren't factored in. Price to sales ratio definitely needs adjustments using fundamentals like profit margin, dividend payout, the growth rate, and the expected return. It's useful still for tech companies, biotech companies, early stage companies, retail, manufacturing, and energy sectors. It can be used for companies with no profits and negative earnings, because revenue, the gross order value, gross merchandise value, the GMV, GOV, or the rooted volumes, RV, whatever terms you're using, all of them tell the value of the company is made on the volumes they are channeling through their portal, to their business, to their company, through their conduit, without bothering about the profits. That is a way of valuing the company. And high growth companies, cyclical companies, early stage having potential for growth, and turning around companies, they all can look at price to sales multiple. When a company is turning around, you will value it simply on price to sales only than DCF and other things. DCFs, of course, you will do if you can justify the projected numbers as contractually possible. In its absence, looking at the growth with an average by levelizing, you will simply use price to revenue, price to sales or revenue as the metric, and you report the valuation of a company, and then divide by number of shares per share. EBITDA. It's also called enterprise multiple. After PE, if there is another multiple which is widely used, it is EBITDA. And people get confused, is it EBITDA or EBITDA? You can simply remember EBIT, which is also widely used. If it is EBIT, here also it has to be EBITDA. So that way you can remember. I find many of the news items, books also misprinting DA, DTA, TDA here and there. The simple way of remembering is that now it measures the whole of the company. This is enterprise valuation, which means enterprise value, which is sum of market cap of the company, the equity valuation of the company, plus outstanding debt of the company, minus the cash flows in the company, which is enterprise value, is one of the most reliable valuation of a business. Why? It captures not only equity, like what we saw until now, which were all capturing only the equity part, not the entity part. The debt enters when you look at the enterprise valuation metrics only. Until then, we saw only equity multiples. Now we see equity and also the debt both captured in the multiple, which is EV multiples. So EV has this beauty of capturing debt and equity and excluding the cash, because cash can be exchanged as it is fluid. And the core operating profitability is captured in EBITDA. Therefore, EV by EBITDA is one of the finest multiples which is used across the world, next to PE, which is a quick measure. It is capital structure neutral. Why? The depreciation is kept aside. Tax neutral. Why tax neutral? Because it is considering debt and equity. Company will have its challenge of managing its EPS. Therefore, that is left to the company. And if it is leaving more profits for the equity holders, it is paying more interest cost, finance cost. If it is saving on interest cost, it is leaving more to equity holders. Therefore, it is considered in a way as tax neutral also for the valuation purpose. And this multiple is mostly used in M&A purposes, while the PE is used mostly for investment purposes or for quick valuation purposes, instant valuation purposes. However, EV by EBITDA multiple ignores capital expenditure. The capex and working capital needs in the days to come are not considered, because a company which has higher capex requirement may have a different valuation. A company which hardly has any further capex requirement will have a different valuation. Therefore, to this extent, there is a scope for overstating or understating the cash profitability. It's suitable for industrial companies, telecom, energy, manufacturing, and capital intensive sectors. And for companies with high depreciation also, it is useful because depreciation is put aside. Now, EBIT. It talks about the operating profits. It compares the company's valuation to operating income. EBIT is considered as a better metric than EBITDA, although EV by EBIT is less used as a multiple. This is considered as a finer multiple, like PEG, price earnings growth, versus price earnings. PEG is less used, while PEG is more relevant, more accurate, and more reliable. PE is used instantly. Similarly, EV by EBIT is a finer multiple, more accurate multiple than EV by EBITDA, but still EV by EBITDA is ruling the market. That apart, why EBIT as a multiple, EV by EBIT as a multiple is better? Because it also considers the depreciation. And when there is a difference in the depreciation of the assets and the volume, which gets the cash flows into the company, EBIT is better. But it is again independent, neutral of financing and taxation. Similar to EBITDA, EV by EBIT multiple also doesn't consider capex, although the outstanding depreciation on the outstanding assets is factored in. The future capex requirement is also ignored, like in the case of EV by EBIT. It's suitable for broadly the same. However, the companies or the sectors which may have impact with the non-cash charges will find it better to use EBIT.
Mr. Kishore,
Yes, please.
just to see this EBITDA also again, it can be manipulated through due to accrual accounting. So we have seen in Gensal engineering case also. So in that contest, there was an article in Business Line where they stated that this EBITDA multiple also goes for a task, and one has to go for FCF actually. So what is your view on that?
Sir, in free cash flows, what you're computing, there is also depreciation. So you add back depreciation, which is again non-cash charge. What you book as depreciation is getting added, which may or may not be real cash flow, but getting added as a cash flow. And what adjustments you make to get the FCF with future capex and increase in the working capital, the OPEX, are also vulnerable. What it tells is, sir, everything is manipulatable. You can manipulate everything. So there are people, the stalwarts, who said DCF is bullshit. There are stalwarts who said EBITDA is bullshit, like Warren Buffett said EBITDA is bullshit. And some Ray Dalio once said, what is DCF? Bloody. So these keep happening.
The recent Gensol case, if you see the profitability, it is very high actually. But I mean, even EBITDA level. But then the cash flow got, it was a negative actually. So I mean, operating cash flow. So what they said is that this EV by EBITDA is no more, a valid multiple. That was the conclusion they had given.
Sir, I admit that I'm not tracking Gensol numbers. Let me admit, number one. Number two, however, I had good amount of interaction with BlueSmart because I made investment in equivalent company, competing company of BlueSmart, which is Cabbies, which is also operating in MMR, Pune, Maharashtra area, which is also doing very well. Same thing. Couple of my seniors started the company about 6 years back, doing extremely well. Luckily, it is not having the shades what BlueSmart has now. So I have a bit of understanding about BlueSmart model, and I interacted with few CEO level, CXO level team as well. But I am not tracking the numbers of late. But going by what you said, I'm sure they would have manipulated, and any multiple can be manipulated. That is what I feel. It depends on how deft we are, how capable we are in manipulating. So you report what is presentable among so many multiples. In fact, what multiple you use is best known to you. In fact, I will take this opportunity as chairman gave this context. So why this topic, in fact? So why Vijay ma'am, when she gave the option, why this topic? Because we are planning to go public and we are discussing with many merchant bankers from Bombay and other places. So they've been flying in and then making a lot of presentations on our company, showing how beautifully we can be presented, which was a big surprise to us, saying you are very big in this, very big. There are certain multiples which we never knew, which we never used rather, if not knew. They have used and then they said, sir, from this multiple angle, you are too big. You are not mini L&T, you are on par with L&T. I was surprised. Is it us or is it some other company they're talking about? That's the kind of presentation what they make. Taking whichever multiple can give maximum valuation for your company is their approach. So I told, then there are few who were very, very conservative and assigning very low valuation, referring to companies which are not doing well now, which is fact. Good companies not doing well. Then I said, sir, we are very unique. We've got engineering, design, manufacturing, erection, logistics, all capabilities. We are India's largest hydromechanical company for the past 20 years. We have done 200 projects and there is no comparison for us. Then the merchant bankers say, that's your weakness. I was shocked. How is it a weakness? We don't have any competition. If you don't have any competition, there is no comparison. When there is no comparison, Dr. Kishore, there is no proper valuation. You cannot command unless the market is a very upswing where everything goes off in the swing in the mood. So it can be manipulated either way, sir. So Gensol definitely have brought misfame to all the startup entities.
Yeah. The prices have gone down by 90% now. Value eroded actually when they came out with the public issue, mainly because of this issue. Actually, the profit was higher, but the cash flow was nothing actually. Even the rating agencies were cautioning that the company is likely to default because of there was no cash flow, only profit is shown actually. But nobody noticed, and finally we ended up with this one. Sir, another one is that you said the price per book value of normal banks, it should be double actually. If you see the public sector bank share price actually, even Canara Bank, just now it has come slightly above the book value. It was last 1 month actually, be it Bank of Baroda, be it Canara Bank or anything, all were quoting below the book value actually.
Yes, sir. Yes, sir.
It was even if you say Tata Chem actually, it's quoting below book value, even today also.
Sir, Tata Chem case is different. Sir, Tata Chemicals is different. But coming to banks,
Banks,
within banks, we have to differentiate. Not necessarily banks, sir. Most of the public sector entities have got a very low price to book value. And more so, as you rightly said, Canara Bank has for a long time, almost for 18 months, it was around 0.83, 0.84 and below less than 1. This is because the sector has got 1 to 2 as a PB, as a multiple, 1 to 2 PB as a multiple. Many insurance companies, including ANI, including Generali, including AIG, including the sectoral consultancy companies, for example, the Munich Re, Swiss Re, those all go at 1 only, sir. The multiple is 1. In many countries, the Nordic countries, the finance companies go at less than 1 also. That is also linked to the interest rate and the revenue, the NIM, the net interest margin, what they command, etc. And as I said, most of the public sector companies, if you see the price to book value, price to earnings multiple, they are very low, traditionally low. And even now, as you rightly said.
Mr. Kishore.
Yes, please.
No, if the price to book ratio is less than 1, it indicates that is the liquidation value will be more than the price, this one price. Is a good buy, no? Why the price is not moving, or what it indicates? It should be always more than 1, no?
Not necessarily, sir. Sir, book value is book value. As you liquidate, you may hardly fetch even book value also in such companies and sectors. Because if a bank is battered, collecting the receivables is not an easy task, number 1. Number 2, whatever penalties, whatever interest you would have captured, whatever fee you would have captured over a period of time will all have to be adjusted. And on an apple to apple comparison, you may be hardly left with the earned income only and not the projected income or the completely captured income over a period of time, which you generally capture. Of course, Ind AS address that anomaly for other companies, but for banks, as of now, it is still open. So upfront, they are capturing the processing fee, etc., which has to be defrayed over the complete loan period. And all this income will have to be adjusted. And you hardly get what you have in the book value also if the entity is battered. Book value will be a fantastic metric if the assets command higher value than the market. If there are any real estate assets, if there are any antique assets which command a lot of value in the market than the book value, let's say Godrej, it has got close to 1 lakh crores worth of land in Vikhroli. And people say, professionals like you say, it's not 1 lakh crores, it could be 10 lakh crores when it is put in the market. If it is put in the market for sale, it could be 10 lakh crores also. That's a valuation of the land parcels what Godrej owns in Vikhroli. Possible. That's because their book values are far lower, market values are far higher. So this need not be the case with all companies. And assuming there is still value in it, let us for a moment understand there is value in it. Let's say Taj Mahal is available for 1,000 crores. It could be worth 10,000 crores. But unless there is someone who is willing to pay you 1,010 crores, why will you at all on earth purchase that for 1,000 crores? What will you do with that? It has to get you revenue. It has to get you capital gain. If it doesn't get you the revenue or capital gain, what to do with the asset? You don't care what it goes for unless it gives you the return what you require. So it is the expectation of the return.
Okay, thank you, Andy.
Sir, thank you, sir. Sir, there is nothing wrong, nothing right. There are different views. In fact, valuation itself is an art which has got multiple views and multiple views. All of them are right. It depends on the context, depends on the company, depends on the reference, the comparison, etc.
Sir, among even public sector banks, we see certain banks that be trading at very, very low. Like supposing I have a State Bank, PNB, Canara Bank, which are better. Like the banks like Central Bank, no, they're still hopelessly traded. So is it better? That means, see, at least in my view, among all public sector banks should be in one stand. Okay, leave private sector banks. Am I wrong? Or?
Sir, you are right, sir. You are right. But there could be difference in terms of market reach, in terms of volumes, what they command. That could be the difference, sir. I'm not tracking the difference among the banks. As a sector, I understand two things. One, the complete public sector, be it bank or others, always have lower price to book value, lower price to earnings, lower enterprise value, etc. That is one observation which we can hold, which is held valid for the past decades and may command in the future as well. Not specific to, not general, not in general, sir. It is specific to India and some countries. In US, it's not the case. There are government companies which are commanding value on par with private companies. This is for some reason specific to India. That's number one. Number two, why should they command, why don't they command more value than book value or equivalent to book value? There is no specific reason, but people assign this multiple and valuation looking at what it could command if it has to be sold in the market, if it has to be liquidated. So from the second perspective, if it has to be liquidated, maybe the market's understanding is the book value is not realistic, is notional, and may have to be discounted to fetch the realization of the receivables. That could be the analyst's view, for sure.
And even IndusInd Bank is quoting below the book value.
So that is because of the recent
issues.
Recent accounting methodology. One of the derivatives, there are two branches. So when you book the hedging, you transfer it to the risk department. So both departments have different accounting mechanism. So one who sells the cover, one who manage the cover in the market, both will have different accounting mechanism. Because of the difference in the accounting mechanism, they had the 1,500 crore rupees unabsorbed expenses, rather the hedging costs. That is the reason. But traditionally, sir, I am not against a group or a bank, but I generally consider Vedanta, the Hinduja Group, Ashok Leyland, IndusInd Bank, and some companies like this generally as risky bets. I'm not saying they're bad. There are people who have appetite to invest into these companies and have made a lot of money also. They're not bad, they're not good. All I'm saying is they hold risk, and one who has appetite will be fine to invest, and a person like me, they are called dirty stocks which do not go with the market mood, but could go in a different mood as per some other factors, some other variables. So I'm generally away from dirty stocks.
Sir, I think Vedanta is because they pay the highest dividend among all others, or how is it?
No, sir. It is, sir. Infosys also does the same thing. I'm sorry if I'm speaking certain things like this. My views are all personal views. The best of the company, among the best companies, Infosys also paid dividend to suit two requirements. If you check the history, and if we have to be realistic, speak to the truth. One, to meet the promoters' dividend requirements many a time. Number two, whenever there is a tax angle which would benefit its shareholders, who are its major shareholders? Whom are they thinking of? Are they thinking of Dr. Kishore, who owns 200 shares? Definitely no. They must be thinking of someone who is owning 20 crore shares, 2 crore shares. Who are they other than promoters? So one, whenever there is a tax angle which will warrant an early action to benefit shareholders, quote unquote, within brackets, the biggest shareholders being promoters. Two, whenever otherwise promoters require for their other investments. These are the two instances which are played at even by the best company. It may still be the best, and it may be benefiting many like me, crores like me, but that angle also is there. That's number one. Number two.
Just a question. I appreciate what you're saying. These are all very, very personal views, and yes, but it is something which all professionals need to note, that the quality of the promoter and those type of things. But I'm a little surprised, and you can refuse to answer this question. I don't want to put you on the spot. Yes, I totally agree. Even I have the same views on most of these. But Ashok Leyland, a truck and very old company, very old manufacturing plant. Yes, it's owned by Hindujas. What is it, that factor which you are seeing there? You know,
Nothing
which I
specific.
missed.
Sir, you spoke the right word, management quality. Management quality.
Okay.
So we, sir, being a banker, we always use this example. What we say is, it's not the vehicle which is taking you safely to your destination. It's a driver.
Yes.
It's a
Yes.
driver.
Yes.
Give Benz car, give a Merc, Bimmer, give whatever, Lofa, whatever. If the driver isn't efficient, if the driver isn't having the fiduciary, if the driver is not with good state of mind, balanced state of mind, you are not safe. And
Yes.
give the worst of the vehicle, be it the abandoned ambassador or Fiat or whatever. We are not specific about a vehicle, whatever be the brand or the kind, the condition of the vehicle. If driver is capable, he'll take you safer to the destination. So
Right.
this example will be best understood by our friends who are from mutual fund industry, because in the downtime, also they make investments knowing fully well that they're incurring losses by investing into some counters, because they can't hold only cash and they have to enter some counters. So the counters which will give them lower loss, less loss, are their darlings in those downtimes. So same. And that's just to complete the previous discussion, then why do you invest into these government stocks? Why are people investing into these government stocks? Let's say Coal India, ONGC, IOC, BPCL, HPCL. These are dividend spinners. There are days, good number of days when they have paid dividend of 6%, 8%, much higher than the FD interest rate, the fixed deposit interest rate. And at the end of the day, you know, it's a government entity. At the end of the day, you know, it has the sovereign guarantee, and you also know it is going at a price lower than its true value, being book value. So there is upside, there is little on the downside, high on the upside, and you are getting regular income in the form of dividend. Therefore, why not into these stocks? I also own good number of PSU stocks, not for the love for the country or as a patriotism, but for the love for the dividend, what we get. And when you enter these stocks during the downturn of the market, a wise man will usually pair his stocks from others and will put into the government stocks because you get high return. You enter at a very downtime into these stocks, you could get dividend yield of anything between 6 to 8% also. Where else will you get this kind of risk-free dividend yield, still holding high upside on price appreciation? Fine.
Very nice. Thank you.
Thank you, sir. I think I have detoured, but yeah, we have time, maybe. Fine. So price to sales.
Sir, just wanted to understand on the EBITDA, sir. Sorry, EBITDA multiple is useful for high capital intensive units. Is what the one of the preferred mode is been discussed. But sir, EBITDA excludes the depreciation, but it says for high capital intense units. In which case, when we use the EBITDA as a multiplier, does it seems to be overvalued, ignoring the capital cost? How exactly EBITDA will be a right choice in the high capital intensive unit, sir?
Sir, it is as follows. Now, why capital intensive sectors also use EV by EBITDA? Reason is the charge on the profits are factored in earnings before interest, taxes, depreciation, and appropriations. It is earnings before the non-operational aspects. It is earnings before these non-operational expenses, which are assigning a value for the business. Value for the business, not for just equity. Now, if you have a mechanism of, like Gensol, like how the best example what Chairman Sir and our financial other leaders have given, if you have a mechanism of taking the capex off balance sheet by leasing, you could make it as an operating expense. If you have a mechanism of bringing in capital at a low coupon your post interest cost, interest profit will be higher. If you are in a tax exempt regime for any reason, you have post tax higher profit. So keeping these things aside, what are the actual earnings on the capital intense asset that this business has is the essence of EV by EBITDA multiple. Other things can be management decision options, whereas earnings have to be from the business. So long as earnings are from the business, that business could be valued at X. Was I clear, sir?
Fine, sir. Fine.
Thank you. I think you are not satisfied. Fine, we'll take it offline, sir.
Because
No
that
matter, sir, it
becomes
is
too
common.
general. That becomes too general for me. That's why I couldn't completely take it up, sir.
Fine,
Yeah,
sir. Fine.
thank you.
No, what you spoke is right, but it is applied. It is applied. You can also browse and find a bit. So in the cap, this
Dr.
EB to sales.
Kishore,
Yes, please.
this is Shravan. I just have a question. When we take the EV by sales multiple of comparable company, say the comparable company has gone through 5 to 6 rounds of funding in the last 10 years. I am trying to take this multiple for a startup which is going through, let's assume, a first round or a second round of funding. Is it a acceptable practice to take the equivalent round related comparable of the comparable company? I mean, if I am at the second stage of funding, the comparable company could be at a sixth stage of funding. Should I take the EV by sales multiple of its second stage of funding, or should it be the latest? Because it will not be an apples to apples comparison, right? So because my company is at an early stage, of course, it is also having revenue, but the comparable company is a lot more matured that way. So are there any instances, or in a practical world, how do we treat this?
But this A, B, C, D, E, F, G, and H being practically the round of IPO, valuation multiple is not on the round cell. So your H being round, pre-IPO round, the previous being the multiple rounds in the industry, post seed and angel, the multiple will not vary depending upon the rounds. The multiple will vary depending upon the stage of your business. For example, in a very simple example, are you in alpha stage, beta stage, or revenue stage? You spoke that you are in a revenue stage. So
That's
at
right.
what revenue stage are you? And revenue stage of how many programs? You have got 6 programs. As of now, 2 programs are giving revenue. Therefore, you are revenue generating. And when do you break even? And when does these other programs also start contributing revenue? So you always see what is the stage of the business vis-a-vis the stage of a matured comparable business, if there is any. Otherwise, we'll use the other metrics, valuation metrics, the startup metrics.
Got it, sir. Thank you.
Thank you, sir. Please. So if sales is the base, the profitability, cost efficiency are not considered, which is self-explanatory, which we also spoke in case of price to sales. These are comparable. Here we are speaking about enterprise value. There we spoke about price per share. Same is the case for that also. Then cash creators, of course, you say cash is the king, which is like the example what sir told, free cash flows. And yes, cash is a king. Operating cash flows are the best metrics. I also look at the cash flow statement after the P&L statement of any company. P&L, cash flow statement, and then I come to balance sheet. Not the first in the same sequence what they give. We have our sequence. And operating cash flows can explain the strength of the company. And operating cash flows as a metric, free cash flows as another metric, net worth as another metric, and outstanding debt vis-a-vis the earnings as another metric. These 4 can explain about 70 to 90% of the company's financial aspects. And then the other adjustments will have to be made to understand how good it is and what has to be the value we should assign, etc. So cash is the king. EV with operating cash flows is also one of the metric, although it is less used, it is a very valid metric which is still used. The reason being, you can't manipulate cash. You will have to pay tax. You will manipulate cash. There are companies which have seen their balance sheets balanced with manipulations, but the tax is one aspect which you'll have to pay tax to show a manipulated balance sheet with the cash flow, cash balances coming, which is not possible for everyone. At one point of time, it will burst. So it is not so easy to manage or manipulate cash in the long run. Therefore, cash flow based EV is considered as a better metric. However, this also doesn't consider the future capex requirement. Very few could consider. In fact, broadly multiples fail to capture the future capex requirement. And earnings, as sir mentioned, earnings are vulnerable to accounting items. So the best examples are, he has already spoken, Vedanta, Reliance are the best example. Ashok Leyland definitely doesn't fit into this. It's a matured company, and now there is hardly any scope or need or the possibility for them to do any kind of manipulation. But then, yes, the other segments have got this vulnerability. Now, I've collected the latest sectoral multiples so that we keep in mind when we do the simple example. The price to book value of power and utilities, metals and mining are lower. Oil and gas, of course, they are lower. And FMCG, retail, IT, e-com are quite higher. I'm talking about price earnings, price to book, broadly same. First, we started with price to book. Price to book, I repeat, FMCG, retail, e-com, and IT are higher. Now PE, price earnings. As you could see, FMCG 42 is average sectoral PE. If you're asking me about, let us say, Nestle or Lever, their P is about 70, 68, 74, etc. Still considered as holding growth, holding prospects, and people do invest into those companies because of PEG, price earnings growth multiple, which they compute as an addition to PE. And if you see, oil and gas and metals and mining have got the lowest price earnings multiple. Then you may ask me, oil and gas and metals and mining as two classic examples. Price earnings lower, price to book value lower, price to cash flow lower, EV by EBITDA lower, EV by sales lower, and dividend yield reasonably okay, but that is not very important. Then why do companies invest into this? Why do companies own these assets? Why not e-com? Why not only retail? Why not only FMCG? The fact is, companies in these sectors have got average lifespan of 5 to 1,000 years, 500 to 1,000 years. 200-year-old company, it could be Exxon, Mobil, Reliance, of late 80 years old, whatever, are still young in the sector. Unless a company is more than 500-600 years, it is still not considered old. It is at best said matured industry. So companies in these sectors have got almost perennial life, whereas companies in sectors like IT, retail, e-com have got short life. Not all, many, we are generalizing, many. And stable PEs are anything between 8 to 12, 15, etc., which you could see in case of textiles, to an extent in cement, to an extent in power and utilities, banking, etc. Then price to cash flow, of course, these are quite dynamic than the other first two, but also relevant. You could see quickly FMCG has higher price to cash flow because it has got more profits to distribute and it has been distributing more profits. As a percent of
Have we lost the speaker?
Even I think we have lost the speaker.
Lost the
I
speaker.
thought it was my issue.
Yeah.
Vijayalakshmi, can you contact the speaker, please?
He's on mute now. Dr. Kishore,
Dr.
you're on
Kishore,
mute.
you are
If
on
you can
mute, sir.
unmute.
Sir, I think I lost and got reconnected.
Yeah, not.
Thank you, sir. Thank you.
We were discussing price to cash flow, sir, when you kind
Yes.
of got disconnected.
Yes, ma'am. Yes, ma'am. Price to cash flows. Okay. So I discussed EV by EBITDA for myself then. Fine. We'll proceed. Doesn't matter. So you could see EV by sales also in oil and gas, in metals and mining. It is 1 less than 1. Whereas
Could
in
you go back to
FMCG,
price to cash flow and then take us through EV by EBITDA also, sir? Because we kind of lost you.
yes, ma'am. Yes, ma'am. So in price to cash flows, if you see FMCG, retail, capital goods, IT, of late, renewable energy, these things are commanding higher multiples. I was mentioning renewable energy became a darling in the recent past, and it is commanding higher valuation in all multiples of late during the past 18 to 24 months, not before that. It was like any other power and utilities sector much before, and gradually it has got re-rating because of the other reasons what you could sense in terms of ESG, in terms of capital coming at a benign coupon and IRR as well. Now, EV by EBITDA is an example what we quickly look at. FMCG, as I said, dividend yield in FMCG sector is less, but absolute profits in FMCG sector are higher. Therefore, it is commanding higher multiple in EV by EBITDA. EV by sales, we mentioned metals and mining, oil and gas have got lower. And of course, textiles being very matured and saturated industry in a way also has got lower. And sectors like renewable energy, e-com, FMCG are commanding higher. IT, banking, and pharma are broadly stable. They command that range of 3 to 4.5, 4.6 range in the long term. Dividend yield, as you could see, power and utilities, because the price of the share is relatively lower, it is commanding 3.8 dividend yield. So it is like you deposit in an FD for 1 year, 1.5 years, you get the same 4% or 3.8%. But here you have upside. The price may go up more because it is power, utility, and then many being government companies. Then there is dividend yield very low of e-com and renewable energy because of the high price and the low distribution of dividend as well. So I move. We got a few more things to discuss. So these are industry capacity multiples which I spoke about. I touch only one and then we move on. Let's say the 3 crore per key of hotels I spoke about, that is the one. Then you have seen good number of deals happening in the recent past, be it Ultratech, Adani, all those things on capacity multiple in cement manufacturing. So high level, chairman to chairman, CXO to CXO discussions happen on multiple. They sign the term sheet and then will be the look at the look of professionals like you and me conducting due diligence and then make adjustments. Adjustments are suggested by us after due diligence. The capacity multiple valuation is discussed over a shake hand by CXO level, or maybe we are CXO by MD chairman level people. So I move on. Fine. So the recent valuation instances by analysts, deals happened, block deals, analysts, etc. These are the things. These are not away from the industry averages. The SNCs, while many of you know, Reliance 17 lakhs, HDFC 15 lakhs. This HDFC Bank 9 lakhs is in 2023. Now it is 15 lakhs, 15 trillion, 15 lakh crores. So latest number, but these we have taken as and when they happen. So these numbers are known, but what it means is the multiples which have assigned the valuation, highline valuation at the analyst table are as per industry averages and are valid.
Sir, just to interrupt, can we go back to the previous one where you showed Indus Tower and all that?
Sir.
Telecom towers.
Yes, sir.
See, I'm not sure because I myself was in Indus Tower 10 years back and we did evaluate taking over Aircel, but we did not need the towers. We go more by customers. A lot of towers already. So that may be something we all need to look at, that you buy a business more based on the customers and those type of things and not based on just physical.
Sir,
So
telecom,
that's what has.
yeah, correct, sir. Thanks for this correction, sir. Telecom, going by capacity multiple, using the telecom customers has been the latest trend. But back then, 50 lakhs to 1.5 crore used to be the metric for towers trading. Many towers got traded. In fact, the ATC and other, of course, under Power Grid Corporation Limited, there are hardly 6-7 who are having the PQs to build the towers, and other than the foreign players who are coming with their credentials abroad. So most of them have traded their units, the business units, valuing towers between 50 lakhs to 1.5 crore. Subsequently came the telecom per subscriber, per user revenue. Of course, the average revenue, ARU, these metrics have come subsequently. ARU also is metric now.
See, over here, and I don't want to make, because I was actually in the business as a national controller. A tower is only profitable when you go towards a tenancy of 2. If you have a tower with only 1, it is not profitable.
Correct.
So if I am going to look at a tower business, I look at the tenancy and I see whether it's close to 2, 1.7, 1.8, and only then I would invest. Just not based on just physically a tower is there, no one is there, everyone is there in another tower nearby. Then it makes no sense. Okay, but it is not fair for me to talk about something where I'm directly involved over here. Okay.
No, right, sir. Thank you. It's in fact a very good insight. Very good insight. You are very right. It doesn't make any sense to look at a building in SFT terms unless rent is earned. Similarly,
tenancy. Yeah.
It is the tenancy what is important than the number of towers or just idle towers also. So you're right. Now ARU has been the multiple, sir, as you
understand. Right.
The recent deal of Bharti in Africa, the other merger what they spoke, and then for further expansion is also on ARU multiple only.
Right. Thanks.
Thank you, sir. So we've got a quick look. Of course, this is not very relevant. Traditionally, India is between 18 to 22 as a price earnings multiple, India's multiple. Now it is at BSE 24, NSE 23. NSE, when I say BSE Sensex, NSE Nifty 24, 23. So are we overvalued? Maybe I'm not commenting, because if growth prospects are higher, it is not overvalued like how we discussed in PE. But if you ask me on a trailing basis, the past versus now, yes, we are at least not undervalued now. That much we could definitely sense. The top table is highest PE. The below table is lowest PE in the world. Countries also, capital flight to countries from the multilateral investment agencies happen looking at the price earnings multiple of the countries. The bond yields are for the debt capital. The price earnings multiple is for the equity capital. And capital flight happens on a highline basis looking at these numbers. They may also see the like equal to PEG, etc. They may also see PEG for the country and other political stability, other factors. But quick look, it is these numbers which will help them to understand into which country should they invest, should the capital fly, should they take back, etc. Therefore, you will find many saying, now India is better placed in terms of valuation. China is better placed because it is undervalued now. Therefore, capital will move. But because of these tariffs, China may not be a right bet at the moment. Vietnam may not be a right bet at the moment. You'll have to wait. Once the tariff tensions reduce, China, if it commands this lower PE, will be a right bet. There is a risk for India to lose capital to China if things settle down. These all are hinged on this kind of analysis. So this also only for quick look, price earnings, high and lows for reference. You could see the Hitachi 192, etc. Avenue Supermarkets, the DMart 105, these kind of high price earnings. Then similarly, lowest price earnings, Athena Global 0.6. Some of the names, Coal India, price earnings of 7.04, DCM 7.05, life insurance 11.60. So these are the things which you could see how the price earnings, they are for few good companies as well. The market cap of 2.84 crores, Adani 66 lakh crores. They're not jokes, they're high value companies. Dividend yield, as you could see, is far lower in many companies, and Coal India 6.5. 6.5 dividend yield is amazing. Okay. So price to book value, high and lows, same like earlier. Nestle India has got 16.9, and you could see ONGC 0.71. So ONGC 0.71. Indian Oil Corporation, like what you mentioned, many of our colleagues, professional colleagues mentioned about them. You could see now price to book value, NMDC 0.58, Coal India 0.64, ONGC 0.71. These must be not exactly yesterday, day before yesterday, on an average in the past 1 month. Look at the valuation. These all are going at less than 1. Hindustan Zinc may be at 1. All are going at less than 1, which means they're not even trading at their book value. Price to sales now is all about popular companies. We could see Reliance 2.8, Bharti Airtel 3.1, Asian Paints is one of the outlier at 12.4, Nestle 13.2, Bajaj 10.8, and Lever at 9.5. These are the outliers. Price to cash flow, only these are only for reference. So therefore, I'm going slightly faster. We'll do a quick example if time permits. Again, price to cash flow, as I told you, FMCG companies have got huge cash. So Asian Paints is also high at 62.7. Then Bajaj Finance higher. For some reason, when I go to banking, Axis and other banks, I found some difference. I'll have to check why there is a difference. EV by EBITDA, same here also. You could see Tata Motors commanding 5.9, which is lower. ONGC 3.5, lowest. Coal India 5, lower. ITC 20, HUL 26, higher. EV by EBITDA multiples. Then EV by EBIT, broadly same. There has not been any difference in the trend, while in the numbers there is small difference. So EV by EBIT is slightly higher than EV by EBITDA, as we know, because EBIT is a multiple which addresses the depreciation and appropriations as well. EV by sales. EV by sales, here I found Axis Bank slightly aberrant because of the difference between EV and market cap. The difference between EV and market cap has to be debt. So Axis has almost, let's say, 2.75 lakh crores net debt shown here, whereas ICICI Bank has got almost same number in both the cases. That is slightly surprising. However, let us look at company like HUL, Maruti Suzuki. HUL has got same number, literally same number, which means debt is 0. And Reliance 17.5, 19.2. Why is the market cap more? Net debt concept. So it's debt minus the cash and cash equivalents gave negative figure. Therefore, its equity cap plus debt minus cash and cash equivalents is higher than the market, than the EV. That's here. Then EV by CF, I proceed, same numbers, the market cap and this. EV by CF multiple, yes, you can see HUL commanding very high at 38.2. You can see Adani 29.3, Bajaj 36.9, has been a darling for a long time. Now still finding attention of institutional investors. Sun Pharma, after all these disturbances, back again on 26.2. The best or the top is Asian Paints with 64 because of the high cash flows what it has been commanding. Then now, so we came to the title theme. Before we look at the example, we'll look at few inconsistencies. Zomato, price earnings 240, price to book value 6.8, price to cash flow 75.2, EV by EBITDA 110. Look at the kind of multiples, all very high, 152, 70. Now, higher PE, higher PCF, but price to book value is less comparatively. It means this has been burning a lot of cash and therefore the book value is less. IRCTC, again, higher price to book value, 24.5. High price earnings multiple, 82.4. It is overvalued. Why is it overvalued? It is monopoly, monospony, whatever you call. It is single largest buyer of many services, one buyer in a way for many services, and monopoly in deciding its sales. Therefore, it must be commanding these kind of things.
Just a question. When you talk about Zomato, is it worthwhile to compare this with foreign entities like Amazon, etc.? Are they also similar? I mean, high PE and burning a lot of cash.
Comparable, sir. Comparable. Why I say I was invited for the Swiggy's roadshow in Hyderabad as a guest to inaugurate and then give my opinion. And then Swiggy, one is from Bangalore, one is from Hyderabad. The promoters are from here. So I took pride in being part of that roadshow and thanks to them for the felicitation. While we were neutral, not assigning any positive just because they felicitated and they invited, we found these companies, Zomato and Swiggy. Swiggy is valued in the lines of Zomato. The valuation methodology used is not in our approaches. What are the three approaches? Asset, income, and market multiples. Not in these three. It is evidence-based valuation, EBV, showing the evidence of number of subscribers, users, and the revenue flowing in. Of course, at the time, Instamart was just about to, it got launched and about to take off fully. So what we observed was Zomato and Swiggy were valued in the lines of their comparables in the West.
Okay.
Broadly in the same lines, sir. So Dixon Technologies, of course, you know about this. The discrepancies between asset base and market expectations and energy exchange. You could see high price, earnings price to book value. That is because of the premium valuation is given for energy exchange being new age, and Policy Bazaar still not making profits, and it is commanding price to book of 8.7 and price to cash flow 105. It has got cash flows, but not the earnings. Then Tata Teleservices, yes, high PE, low PB. High PE, low PB, because the recent earnings, what it started posting are yet to get captured because they have to show that these are sustainable earnings which would continue on a forward basis also. Then the mother of all, Adani Green Energy, price earnings 145.8, price to book 8.2, price to cash flow 32.5, EV by EBITDA 18.4, and market cap risk. Very high PE, moderate price to book value. It is because the market is betting on its future profitability scope. That is the reason why, in spite of having high price earnings, the stock or the counter is seeing a lot of price appreciations. What do we need to do to iron out the inconsistencies? Use multiple multiples, not one multiple. Consider industry specifics. Adjust the adjustments. Rhetoric, just like that. Business cycles and cyclical sectors will require considering multi-year averages, cyclical averages, quarter-on-quarter comparisons, etc., than year-on-year comparisons. You network the narratives and numbers, only then can you understand if the business makes sense and if the multiple is relevant or not. Growth rates are good, but you have to use the right growth rates, such as price earnings growth, which you mentioned in our PE discussion. Outnumber the outliers. Keep the outliers aside. If you are valuing, keep Adani aside for a moment in that lot. While it may command, it can't be a comparison for other companies because there could be unique features of this company which are not present in the other companies. Same with Nestle, same with Dixon, same with IEX, etc. Latest data is relevant, but Reliance, ITC, LIC, and SBI, these cannot be put aside, how much ever big they are, how much ever outliers they are, because they are the industry. India is these 6-7 companies. Market of India minus these 6-7 companies would be hardly 10-15%. Therefore, you have to incorporate or include all these big bellwethers of the company, of the country, when you value the sectoral players. Latest data has to be taken, then combined with other approaches. We mentioned just now asset approach, income approach, and market multiple approach. What we're discussing is the market multiple approach. Under that, some methods like PE, etc. Appreciate and appraise the limitations, which we included in our self-test check at the start. Now, quickly we'll look at one example. Okay, kindly guide me if I'm able to show you the screen, the Excel screen.
Yes, sir, it's visible.
Yes, ma'am. Thank you. Okay, so I wanted to just show you quickly a small example. So these are the inputs collected: stock price of 3 companies, shares in numbers, total debt, cash and cash equivalents, net income, which is like PAT sort of thing, book value of the company, book value, revenue, the turnover, EBITDA, EBIT, and cash flow from operations. This is from cash flow statement. EBIT, EBITDA from P&L statement, revenue P&L statement, book value of the company from the balance sheet, net income P&L, cash and cash equivalents from the cash flow statement and also from the balance sheet, debt and number of shares from the balance sheet, price from the market. Now, market cap is number of shares into stock price per piece. Enterprise value is, as we discussed, market cap of equity plus outstanding debt minus cash and cash equivalents is enterprise value. Okay. Now, P ratio, price by earnings. Earnings is total revenue by number of shares. The net income by number of shares is per earnings per share. Price by book value. So book value is book value of the company, which is total assets minus total liabilities, the equity money. Book value by number of shares gives you book value per share. Price by book value. Price by sales, same. Price by cash flow, same. Okay. Now, same is the case here. These are entity numbers, those are stock numbers, but here you consider both debt and equity. Enterprise value by EBITDA, enterprise value by EBIT, enterprise value by sales, enterprise value by cash flows. Okay. So taking those things, I try to see how do we compute valuation for DEF. The share valuation based on the industry average multiples which are collected from for these stock and entity are captured, and we have got this valuation using the same industry average multiples. Then I compared to look at if these are the values prevailing in the market. They are broadly within the same range, except during any aberrations, broadly within the same range. What this explains us is both share valuation and the entity valuation. Also, both are on the same. This is complete market cap. This is per share valuation, and the entity valuation are these things. What I found is almost all are in the same range as they're commanding their valuations in the market. EV basis, I will not comment much, while I would say positively they are in the range, because some of the EV valuations may not be known as they're very dynamic. Today I repay a big loan, tomorrow my EV will differ. But range wise, they're all well within the range, and therefore the valuation multiples are reliable. We can use, but with the adjustments to iron out the inconsistencies what we spoke. So I wanted to just check if this is holding the truth or not. The price to book value and price earnings multiple. 3.75 is price to book value, what I computed using the PE thing, and PE is equal to price to book value into return on equity. 18 is the price earnings. I want to see if it is exactly the same or not. It is the same. So which means these multiples have valid calculations and can be used. Return on equity, price to book value into return on equity into price earnings is return on earnings, 20.83. Do you have it here? Okay. Return on equity. I think I have not computed here. Fine. We can compute here. No issue. Return on equity is for A. You got here revenue divided by per share. These all per share is equal to net income divided by book value of the company. So it is exactly matching. What this means is, in summary, valuation multiples are reliable, but need to be adjusted with the suitable adjustments so as to have them as a validated multiple numbers. So now we are done. We can take any 1 2 questions. Should we have time?
Sir. Hello.
Yes, sir, please.
Yeah, sir, here for the adjustment, I just want to check if we are valuing the unlisted private limited company using the multiple methods. So apart from DLOC and DLOM, what all other adjustments we need to do, and how scientifically also we need to prove, even for DLOM and DLOC also. So if you can just guide on that.
The discount on lack of marketability, liquidity, those things we take depending upon the situation of the company, sir, specifically of the company. So today, having lost, let us say, Z Enterprises from 27,000 crores, it is having a market cap of around 270 crores. So it is now it lost 90%. So today I can't use the same valuation multiple. I will have to give the discount on account of liquidity, on account of marketability, on account of control, and these things. Now this may be available at 100%. So I don't give discount on control because it is available almost substantially. But discount on marketability, who is there to purchase that? So those discounts, what we give on the valuation of an entity, are situation specific, company specific. For example, if I am valuing a stock for a party, for an investor who is in need or who has deal of investing of or picking up 100%, discount on lack of control is not required. He is picking up 26, we give a discount 2%, 5%, 10%, 11%, 24%, 26%, 49%, 50%, 51%, 74%, 76%, 89%, 90%, 91%, and 100%. These are the thresholds at which we assign various discounts, understanding the control, understanding the blocking capacity, understanding the ability to move the motions in the company, etc. Or with the regulator. Of course, when we say 11%, it is the NCLT matter, 2% IT, 5% exchanges, 74% you are major shareholder, but you can't block the specific rights of the other shareholder. 76% you are substantially shareholder. 91% democratically you are 100% shareholder. The other party can't do anything literally because the 11% required to move the court of law is absent with them. Like each of the threshold has its own discount what you will assign.
So, sir, it depends on the valuer only? whatever discount he need to apply? That's the questions.
Discount on the depends on the situation, sir. Depends on the situation, sir.
No, so for example, let's say we are valuing for 2% and we are comparing the multiple. Then what kind of the discount we need to apply, and how we need to adjust the growth rate also of the listed company and the unlisted company in the multiples? How? What is the way?
Sir, now in this case, discount on lack of control is not a point at all. It's hardly 2%. So he is more like a strategic investor who are coming as a financial investor who is coming only for returns. So when someone comes only for returns, what we look at is the value of the company as a multiple versus the growth period within brackets, the investment period, let us say 4, 5, 6 years, and then you discount and then you arrive at the value. Now on this value, is he in requirement of 15% return, 18% return? What is the return that is agreed upon between the investor and the company will discount the future value to the current value. That is the valuation what you are giving. How is the future value arrived? Future value is arrived at the normative multiple. For example, 4th year, 10 crores is the projected or promised assured profit.
Sir, but as a valuer, if the company is asking us for a valuation independently, okay, using the multiple method, we don't know what the return they are agreeing to the investor. What the valuation approach? See, I now arrived at the multiple of the comparable company. Now, what is the next step to arrive at the independent valuation?
Sir, as a valuer, we will have to look at WACC only to arrive at the fair valuation.
Sir, multiple method, not the DCF.
No. In multiple method, if you are, sir, there are two things. Now, in multiple method, if you are multiplying the current multiple on the present EPS, let us say, it is present valuation. There is no adjustment required on this number unless you have the need of the size, comparability, etc. Now, you are talking about for an investor who want to acquire 2%, 4%. Then you look at the future valuation as per the investment agreement and then discount. So for a valuation which is made at the moment on the present numbers, you make the price earnings of a comparable company into the present earnings. Now are the adjustments. What are the adjustments? Is it comparable company? To what extent comparable? It is comparable to the extent of 60%. Okay, 40% discount. Number two, is it in the same growth phase? Yes, fine. No. So what discount should we give for this company to be equivalent to the other matured company? Let's say one of the HCL Tech. So this company is the same line of business equivalent to HCL Tech. To match that, how many more years it would take? So therefore, assuming that it will become HCL Tech equivalent in 5 years, 4 years, what is the growth rate required? That much you discount. So while critically speaking, we'll go only with the present multiple number, when we look at the valuation in the paper, we have to also use the discounting numbers, because when you look at phase, it requires discounting for the next phase. Was that clear, sir?
Yeah. And sir, what about the for discount for lack of marketability? The liquidity discount, how much we generally need to apply? Because see, that is very subjective. So is there any scientific method to arrive at that, so that tomorrow nobody could contest that?
No, you spoke the right word. It is subjectivity. I have seen people who are using only 10%, people are using 25%. I've seen an instance where someone used 40% also. Generally, 25% is not questionable. 25%, 20% is not questionable.
Thank you, sir.
Thank you, sir. Thank you.
Sir, I've got a question. Can you hear me?
Yeah, please, sir.
Yeah, when there is a price devaluation of 90%, as you mentioned in the case of, I think, Z Group. So what is the role of the valuer, in that case? When the price was 90% up and that is the time he was doing the valuation, what would be the role of valuer then? And how he is going to estimate that it is going to come down by 90%, let's say within 2-3 years or maybe 4-5 years?
If you recollect, sir, we said narratives and numbers need to be networked. What does that mean, sir? We will ignore in a way the past valuation regime of 27,000 crores plus 21 to 27,000 crores plus. We are looking at the current 271, 272 crore rupees valuation level only. From this, what is the scope for the company is what we'll consider. So we are concerned about present situation and the prospective situation. So the forward of 1 year is what we look at, and the trend is what we look at and we value.
But even then, somebody does the valuation at that point of time. Do you think it will, come to the numbers that eventually has come to, let's say, after 4-5 years? I think still there will be wide gap, between the valuation and eventually what had turned out to be the value of the company.
There are gaps, sir. In fact, sir, to admit within the four walls, all of us being same fraternity, in very few cases, rarely are the valuers making valuation. Rarely are the clients using the valuation given by the valuers for their negotiation tables. They come with one number and they give a challenge that this is the number around which you have to arrive at the valuation. And then the valuers take the challenge, they build the model, and then they arrive at the value and they give it for the table. This is not untrue in majority of the cases. It is not that we are doing a bad job. For sure, we are making one valuation on our own to understand what is the truth. The truth is in our mind, and we give a valuation number, what is in the mind of the client. This is fact, whether we admit or not, speak to the truth. There are few cases where two equivalent partners, where they want to know the value, professional value, and then they discuss. Those are very rarely found. One of the Delhi High Court Chief Justice, in his retirement speech, he made a fantastic quote which became viral around the world, that he said, in the court of law, both the parties know the truth. It is the judge who is on the trial to find out who is the errant, who needs to be punished. So same is the case. Most of the cases we do one valuation. We understand, oh, your value is 1 or 2 rupees, fine. And then we listen to the promoter. Sir, at any cost, I want 450 rupees valuation per share. And then you are giving 445 to 462 rupees valuation. He'll get 3 valuations like this. And he'll show to his banker or investor. And he says, whoever gives, this is the valuation range. And therefore, I command 450. And you put 20% discount, what you require, minus 90. So 370, 360 is the value my business commands. That is how he is doing.
Okay. Thank you very much, sir.
Fine, sir. So I think we are done. We'll call it a day, sir. I have to take up regular office works. Thanks to all of you for your patient participation. And I find very interesting and challenging question. Lot of value additions from our learned members. Good number of additional points are added. My sincere thanks to all of you. My thanks to BVA, my thanks to IOE, my thanks to Vijay ma'am for timely coordination and excellent thing. And entire management committee, chairman sir, vice chairman sir, and treasurer, secretary, and other committee members. A sincere thanks to all of you.
Thanks.
Thank you, sir. Kishore sir, I request Ravichandran to deliver vote of thanks for today's speaker.
Okay, ma'am.
Yeah.
Thank you.
Ravichandran,
Thanks.
sir?
I'm here. Yeah. Thanks, Mr. Kishore. I think it was a very, very wonderful interactive session after a long time. I mean, it was very good. Actually, you started with what are the things you are doing, and then you started saying that the limitations and also the advantages, and then it went on for a deeper, analysis of various multiples, and still all of us, we are still facing these challenges whenever we do the valuation in on various grounds, actually what to apply and what not, and how to do that. It was a very wonderful interactive session, sir. We thank you very much. I mean, we could see the amount of efforts you have taken to collate all the data. Actually, it was very wonderful, and I know we sincerely thank you on behalf of BVA. And ma'am, on behalf of BVA, we also give a memento actually, which will be courier to you. This is the one actually.
So that can be your last. You already given, sir. I am having many. I show you.
So no problem, sir. You can have one more, sir.
Backside all day only. All day only. Many. Maybe I was suggesting, ma'am, that from now you should send a simple certificate than these trophies. I have many, sir. All background that only.
With the permission of the organizers, I want to convey thanks to Dr. Kishore on behalf of the participants for his excellent presentation. To my good friend, Dr. Kishore. You have splendidly dealt the way. Thank you on behalf of the participants also. And as is suggested, instead of memento, you can plant one tree at any garden in his name. That is always best.
Thank you, sir. Thank you very much. Thank you. He's our professional leader here. He's our professional knowledge leader. So
Sir,
slightly
multiple-
younger to me, but ahead in profession, knowledge, leadership, and been doing wonders, encouraging all of us.
Yeah, thank you. Thank you, Kishore. So
Thank you once again, sir. Thank you, sir. Thanks a lot.
Thank you, sir. I take leave. Thank you. Thank you again. Please. Thank you.
Thank you very much, sir.
Thank you, ma'am. Thank you, ma'am. Please.